Welcome, you're watching the Mutual Fund Show. I'm Tamanna Inamdar and our focus today is on sectoral funds. Sectoral funds, in a sense, have fallen out of favor. Let's take, for example, defense funds. Defense funds, and one or two of them have stopped taking more money in them, but have also seen a bit of underperformance in the last 1 month. Now, if you look at 5-year returns, of course, it's been great. But if I look at 1 month performance, you will see that there hasn't necessarily been that kind of up move. Now, the question we're asking today is, should you re-look at your investments in sectoral funds? Who are sectoral funds for, and which are the sectors which make sense right now? To speak on this, I'm joined by Kirtan Shah, MD of Credence Family Office, and Mrin Agarwal, financial educator and founder of Finsafe India. Welcome to both of you, and great as always to speak with you. Mrin, let me begin with you and just really get your inputs on what we're talking about sectoral funds.
So good afternoon, Tamanna, and it's lovely to be here today. I have never really recommended sector funds. And, of course, there's been this huge inflow this year into sector funds, mainly in manufacturing, infrastructure, consumptions, business cycles. But again, if one were to see the performance of various sector funds on an annual basis, and this is just data that I got of Value Research. On an annual performance, if you look at the category returns, you see that there's a lot of variation in returns in sectors, right? So, for example, there are certain sectors which do really well. And then, like, if you look at 2021, you had certain sectors like, for example, energy, which did really well, but then it had a really bad performance in the next year. Or if you look at technology, right, 21, you see a 63% return followed by a minus 23% and then 30% last year. So, the thing with sector funds is that they are extremely volatile. And as such, I feel that whatever other high conviction ideas within these particular sectors would anyway be there in the broad-based funds.
Okay. The question really is, and I actually have this data right here, the thematic 1-month returns has right now not been as great. And maybe the reason is that some sectors have not been doing as well as others, whatever the reasons might be. Now, my question to you, Mrin, in that sense is, should you really relook at your portfolio in terms of sectoral funds, move out of them, or just stay put for some time?
I think it's always a good idea to exit and reallocate to broader based funds.
That's a very clear-cut answer there. Kirtan, would you agree with that?
Tamanna, I think I am very much in sync with what she has to say, because look, in my opinion, sector funds are meant for very sophisticated kind of investors, and it is never, or it ideally shouldn't be a part of your core portfolio. Your core portfolio is still more market cap based investing, which is more diversified. You might have 10-20% of your investments which probably may align to sector investing, provided you understand that this is a very sophisticated way to invest. So I don't really think this is for the larger set of audience, because in a sector fund, if you cannot get your timing correct, both the times while entering and while exiting, you probably might end up being languished with underperformance for a long time. You look at infrastructure at the peak in 2008, people took decades to actually get back the performance in infrastructure when they invested at the peak of it. So I think cyclicality is a very big challenge. Identifying which sector will make a lot of sense at what point in time, and specifically being able to time the exit, are big challenges which probably retail investors are not meant to do.
We'll try and get this chart up of 1-month returns, and you'll see that how, especially in areas like infrastructure funds, you've seen a fairly poor sense of returns, and in some cases negative returns as well. Now, let's come to this bit that, Kirtan, you are having a lot of new fund offers focusing on sector and thematic funds, because there has been a pretty good run up in the last year or so. Would you say that they're all in a void, or would you judiciously pick some of these?
Ideally, very honestly, one single data point, if I have to look at and generalize this, I think the day you see a sector fund NFO coming out, it's a temporary top in that particular sector. Because the reason why a sector fund typically comes out is to be able to garner larger AUMs, right? And that is only possible if there is a lot of buzz happening in a particular sector. Is what NFO do you really want to come out with? So if I have to really generalize, I would rather say that the day you see an NFO coming out in a particular sector, that's a temporary top. Don't try and invest in that particular NFO. Because like I made a comment in the last discussion also that you and were having, that of course, as somebody who's sophisticated might have a view for a particular sector to do well, but from a retail standpoint, you are more good to be with a larger diversified fund, because if you can't exit, you probably might not really be able to do what you were envisaging while you wanted to invest in the fund. So we might have some picks on some particular sector, maybe wanting to do well or end up doing well over the next 2 3 years. But from a larger retail standpoint, they are definitely a big. I mean, they'll be in a better position if they avoid doing any of these things and stick to more diversified funds.
Okay, stick to more diversified funds. Now, you also mentioned, Chintan, that Kirtan, that you think healthcare or pharma is, a good bet. Are there any of those funds that you would like to look at?
Look, again, before I start commenting on which sectors do we like, I think a disclaimer that we probably know why are we entering these funds, and we probably would know when to exit this. And this may not stand as an advice for anybody who's wanting to hear us on this show. But we think pharma probably is a good time to bet on, because if you look at the latest results, I think the recovery in terms of P&L cash flow is happening very well in all or largely all of these sector companies. Second, I think this sector is largely under-owned. So you pick up any diversified fund today in the MF space and you will see a very small allocation to pharma. So under-owning to this sector also makes a lot of sense, because of which pharma makes a lot of sense to us. And also, this is one sector which we really feel is fairly valued at this point in time, versus some sectors which are obnoxiously highly valued. So we feel pharma is something that you definitely can look at. But again, a disclaimer, very important for you to know why are you investing and specifically when to exit when you take sector calls.
Yeah, having said that, I mean, the context of this conversation is mutual funds that are investing in sectors. So one assumes that intelligence lies with the fund manager. The question is that can you, in a blanket fashion, say don't go into this, because sometimes you just really, managers are there, fund managers are there to have the timing in place. Mrin, any sectoral funds you would look at all as part of the portfolio?
Not really. And I think, to just add to what Keaton said, I think if an investor is desiring to invest in sector funds, it could be, because they are from that sector and possibly have some better knowledge about it. Or, if it see, whenever you're investing in a sector fund, you are taking a very concentrated risk. So, as Keaton also said, this is not meant for a majority of investors. But yes, if you have a particular viewpoint on a sector, do work with a financial advisor, because they are the ones who can give you that particular intelligence. On one's own, it's very, very difficult to figure this out. And again, I would say please limit your exposure to maybe 5% or lesser of your portfolio. But as such, on an overall basis, I do not recommend it.
Okay. So that's about sectoral funds, and we'll add more charts on that as we go along on which are the sectors and how they performed in the last 1 month. But let's take your queries, the numbers on your screen. And the first question today from Riganka Das, age 34, who says, I've been investing 20,500 rupees a month with a 10% step up. My portfolio value is 14 lakh rupees and my goal is to build a big retirement corpus. Please suggest some sectoral funds for the next 3 to 4 years. There is no qualifying what this big retirement corpus is, but there is an ask for sectoral funds. Kirtan, let me come to you first.
I think the answer is in the context of the discussions that we are having here.
Yeah.
I think if sectorial funds is what the individual is looking at, you can look at SBI Banking and Financial Services Fund. you can look at the Tata Digital, and you can look at the Nippon India Pharma Fund. Not a great fan. I would rather still suggest that you keep this all of these three funds not more than 10-20% of your overall allocation, and be very mindful that these are going to be moving very quickly, unlike most of the other diversified funds in both directions.
Okay. Mrin, what would you say, considering you said no sectoral funds at least 3-4 times in different ways, but now Mriganka wants to invest in sectoral funds, you have to give them an alternative.
Well, I would still say no sector funds, certainly not for 3 to 4 years, because the time period you mentioned is 3 to 4 years, which is incredibly short. Of course, as Kirtan has mentioned about the timing aspect on sector funds, I still wouldn't suggest it, Priyanka, honestly, because he's already got a focused equity fund in the portfolio, which anyway tends to be a very, very concentrated exposure. And again, you have mid cap, you have the small cap funds in the portfolio, which are quite volatile. So even though the person is young and they can take some risk, I would just say take the risk in a broad-based fund and just add to some of the funds, like add to the mid cap and small cap that you have. Look at, some other mid and small cap funds which can give you consistent performance is what I would say over taking this sort of a concentrated bet.
Okay. So let's go across to our next query, which we want our guests to answer. Kunal has written in, age 36, saying, I'm planning to start a 1 to 1.3 lakh monthly SIP. I have 6 lakh rupees worth FD as an emergency fund. I only have HDFC Nifty Index Fund in my short list. Where should I allocate funds? Now, they haven't said this clearly. Kunal hasn't said this implicitly, but I'm assuming the part of the question is that should I let my 6 lakh rupee emergency fund in FD remain there, or should I deploy it? Mrin, will you take this first?
Yes, so certainly, of course, you need to have an emergency fund. And while we are seeing great markets in the last 4 years, we mustn't forget that we need to be prepared for any emergency or any contingency. So, of course, you need to keep that 6 lakhs in that fixed deposit for the emergency fund. Now, as far as the SIP is concerned, of course, the HDFC Nifty Index Fund is a great way to start. I also think that he could add the Parag Parikh Flexi Cap Fund and add a mid cap fund like Mire Mid Cap and possibly a small cap like Nippon India Small Cap. So, these 4 funds together, which is the Nifty Index Fund and then the Parag Parikh Flexi Cap, Mire Mid Cap and Nippon Small Cap is what I would recommend.
And what would be your recommendation, Kirtan?
No, I think I'm very much in sync with what Mrin said, because I also believe that probably, though I don't know the risk profile of the gentleman that we are talking about, but assuming that he has 8 to 10 years of investment horizon going forward, I'm a very firm believer that just large cap or just mid or small in the portfolio does not really give you the best risk adjusted output. So having investments across large, mid, and small will actually be able to build a very good risk adjusted portfolio. Only one element, while she's spoken about the funds, the only element that I would want to add here is that look at doing 33% in large, 33 in mid, and 33 in small, provided that you have at least 10 years of investment horizon and your risk profile is slightly higher, because that portfolio will give you a very optimum risk adjusted benefits over a longer period of time.
Okay. Adarsh writes in, age 43, says, I'm investing 60,000 rupees per month SIP in 6 schemes. My only goal is to attain financial freedom with a corpus of 3.5 crores in the next 14 years. Requesting your feedback. Well, very good and clear goal. He's given time also for this. So when he's closing in on 60, he wants complete financial freedom, and 60,000 rupees per month is going in 6 schemes. But does the math add up? Kirtan, let me come to you first.
Adarsh, my suggestion to you is that you will have to increase your 60,000 a month to roughly 85,000 rupees a month, because assuming 12% return on the investments that you would make, it'll take 85,000 rupees a month for you to be able to reach 3.5 crore rupees in the stipulated time of 14 years. So if you cannot immediately increase your 60,000 to 85,000, try and step it up increase it by 10, 15, 20%, whatever you can year after year, you will probably be able to reach the goal much faster. But if the answer is to increase it at one time, your 60,000 will need to be increased to 85,000. I feel most of the investments that you've done is very good and you should continue. I would only advise you against the HDFC retirement savings. If you can get rid of that and reallocate all the money that you receive from that to the other funds in the portfolio, everything else in the portfolio looks very good.
Okay. Mrin, what would be your advice over there?
Yeah, I would actually concur with Kirtan as well on the HDFC Retirement Savings Fund. And, when you look at this particular category of retirement savings, it has generally underperformed for the reason that, first of all, it's very difficult, to track this category because you have funds with different exposure to both debt and equity. So most funds are managed like balanced funds. So if you're looking at if you're looking at growth and you're at a situation right now where the amount that you have to invest is lesser than the amount that you should be investing, and at the same time you do have a good time period of 14 years, you should certainly be looking at funds that can help you have a high growth in those particular 14 years. So maybe a balanced fund may not be a great strategy at this point in time. And I would actually say reallocate it to the existing funds that you have in the portfolio.
Okay. Noel writes in, age 23, says, I'm investing in mutual funds with the aim of long-term wealth creation. My current portfolio value is 6 lakh rupees invested equally into 6 different funds. Says, I also have a monthly SIP of 3,000 rupees each into each of these schemes. And look at the portfolio. Parag Parekh Flexi Cap gets 3,000 rupees. SBI Contra Fund 3,000 rupees. Kotak Multi Cap, Quant Momentum, Motilal Oswal, Quant Small Cap are those funds. And of course, all equally distributed. Mrin, as a strategy, does this equal distribution make sense, and what would you change over here?
I think it's okay to have the equal distribution, because again, the risk profile of the individual has not been given. But I'm not in favor of momentum funds. And right now, of course, you'll be seeing some great returns in these funds. But again, when you're looking from a long-term perspective, I really think that, he should actually exit the momentum fund and again, reallocate among the fund where he can actually take a higher risk. So since he's only in 20s and the idea is, again, financial freedom, I would actually say reallocate and maybe have a higher exposure to the mid cap and small cap.
Yeah, just, on small cap funds, and this is a question I have for both of you, Kirtan as well as Mrin. I'll start with Kirtan. SEBI came out with a sort of a warning on SMEs, not small cap specifically, but on SMEs, and talked about how promoters are making announcements which have the stock run up, and then, investors come in. Just extending that to small cap funds, should, we look at this also very carefully?
I think the reason why most of us are investing in mutual funds is because we want to rely on that intelligence for the fund manager and the ecosystem to do that, right? I think if we go 6 months back or 8 months back, SEBI came out with a similar warning on liquidity, and which is why we saw all of these funds now issue liquidity announcement with respect to each of these funds. And while I've been tracking that data very closely for as long as it has been existing, I think mutual funds have been doing a great job with respect to being able to filter that to make sure that the objectivity of the fund is kept in mind before any of these investments are done or retained. So I think I would want to leave this decision to the fund manager and the team that I've chosen to invest in, because I think they'll be in a better position to be able to do this filtering versus somebody like us sitting on the outside being able to do this. Of course, with that, I want to add one very important point that I really want to make here is that, of course, small caps have been delivering or have delivered in the recent past some very outstanding returns. My only problem is that a lot of investors look at this return and end up investing, and which is the reason why I think most people will rather end up being disappointed in the next 2-3 years if they've looked at the last 2 3 years of return and entered. So if you are in for a long haul in terms of investing, you know why you've chosen small caps, you know your risk profile is in place, and you will not lose sleep because of the volatility. I think everything else the fund manager will take care of, because SEBI's done a great job in making sure that the regulations are in place for the MFs to stick to objectivity.
Okay, Sunny Kumar writes in, age 28, says, I want to invest in mutual funds with a 20-year time horizon, aiming to invest 7,000 rupees per month through SIPs. My goal is to save money for my daughter's education and marriage. Please suggest some funds. You know, Puneet, Sunny, we did a whole show on how to use mutual funds to save up for your child's education, and do go back and see that as well. But meanwhile, Mrin, why don't you take this question and let's add to that a little. There are a lot of products out there focusing on children's future. Is that the first stop that should be looked at?
Absolutely not, and certainly not if they're from insurance companies. When you look at all the child plans that are available for higher education, again, the problem with any investment-linked insurance is the fact that it's high cost. And I know that there's all this marketing gimmicks of no LTCG and all this happening. Please don't fall for that. Because at the end of the day, if the return itself is so low that doesn't beat inflation, and mind you, inflation on education in India is between 7 to 10% per annum. So when you're looking at where to invest, that should be your prime consideration, and not whether LTCG is applicable or not. So that said, I think mutual funds, again, are a great way to invest and save for child education. Again, look at the broad-based funds. You really don't need to get into the child education schemes, because they have the same problem of being managed like balance funds. So I would again say, since you have a 20-year time horizon, make a portfolio of a combination of flexi cap, mid cap, and small cap.
Yeah. Okay, that question for Kirtan as well.
I think everything else that Mrin did mention, but one point that I would want to raise is, because sometimes typically what happens is that when you have a smaller investment that you start with, and then you are going to increase that over a period of time, a lot of people end up doing this mistake where every new investment that they do, they keep adding more funds. All I want to add to what was already answered was, don't add more and more funds to your portfolio. So if you have 7,000 rupees that you want to start with, and you've decided a large, mid, small that you want to invest in, every new money that you would want to invest, just keep adding to the same funds, and don't try and add to the number of funds, because that is counterproductive and does not really solve any problem.
Okay. Thank you so much, Mrin and Puneet, for speaking with us today on the Mutual Fund Show. And as we wrap up the big story you're seeing on your screen, let's pull up the RIL chart. The board will be considering a 1:1 bonus on the 5th of September. You've seen the stock nearly at its day's high, touched a high of 3,072 before a slight slide off there, but RIL 2.5% up. Obviously contributing heftily to the Nifty. Let's pull up the Nifty contributors chart and see where the Nifty is going after that news from RIL. Remember, the news coming in ahead of the bonus issue. Yeah, that's right. The RIL news actually lifting up the Nifty nearly 100 points up, well above 25,100 mark. The AGM is later this evening, and ahead of that, it was widely expected that there would be some key announcements. This definitely is one 1:1 bonus issue on September 5th coming in from Reliance Industries. All right, that's all the time we have today on the Mutual Funds Show. Stay tuned, a lot more coming up on the other side on NDTV Profit.